Managerial accounting is one of the more challenging aspects of this course, so let's spend some time talking about financial statements in terms of how you'll use them in your business. First thing to understand is that there's several different financial statements you'll use, and there are two ways you'll be using them. Taking the data that you are gathering right now for your accounting section of your business plan, you could take that information and use a system like QuickBooks, or you could visit an accountant, and you could generate what are called pro forma or forecasted financial statements. As you've seen in Chapter 4, these forecasted financial statements are almost always expected in a traditional business plan. Because of the length of the course and the fact that I really can't expect you to generate pro forma financial statements, I am not expecting those, but I did purposefully define the accounting section contents so that you could take that data and go into a QuickBooks or other system to generate forecasted financial statements. So you'll use forecasted statements to make sure that your business is achieving some of the same financial ratios in terms of cost of sales, in terms of profitability, as other businesses in your industry. So that's what you would do before you launch your business based on the forecasted statements. Once you're up and running, you'll be using your statements to manage your business more specifically. Let's take a look at the income statement. The analogy of an income statement in your real life is the financial statement you get from your bank every month. It usually shows your checking account, your savings account, the ins and outs of that account, and an ending balance at the end of the month. Same thing with an income statement. It's going to show what revenue you had, what expenses you had, and it'll show if you achieved a profit or not, just like your accounting statement from your bank shows you. And hopefully that's a positive number at the bottom. It may not be. Crucial thing to understand about an income statement is that it's over a specific period of time. The income statement should specifically say that it's for the month of June or quarter 2 or an annual year's worth of data. It has to have a start and an end period. These are some of the items that you'll see on an income statement. If you've heard of earnings before interest and taxes, or you've seen EBIT before, that appears on an income statement. Your gross profit as well as your net profit will appear on an income statement. So let's take a look at this one. You can see it on page 339 if you want to look more carefully at it. It's hard to see this on the small sheet. A few things to point out here. One is that labor appears in two places. Labor that's associated with creating the specific product is shown up here in the cost of goods sold area. But you also see a salary down here under the fixed or overhead costs for this business. That second salary is very likely associated with some kind of a manager for the business, and that person will be paid regardless of if you sell a product or not. Whereas these labor expenses will be incurred only if you sell an item. So there's a difference there. Similarly, packaging is shown up here as it's associated with the product. If you are, for example, shipping out business cards or flyers or promotional materials, those costs would be overhead costs because they are not directly associated with a sale, and they would appear down here. Depreciation appears here. Many of your businesses will not have a depreciation line, but if you, for example, use a personal computer that has any value to it, you can capitalize and depreciate the cost of that computer over time. Since we're talking about depreciation, I have switched over to Chapter 12 slides to discuss that. So the example is your computer that you're using for your business. The government, specifically the IRS, determines a range of useful lives for all items. Most likely a computer useful life would range from 2 to 5 years. At my previous company, we depreciated our computers over 2 years because we replaced them so often. But for small business use, 4 years is a reasonable length of time that you can expect your computer to be functional and helping out the business. So you need to know the value of the item and how long it is useful for. And then what you do is, in this case, because we're doing a useful life of 4 years, every year 25% of the computer's cost is reduced. So that on the assets, on the balance sheet, the computer is initially listed as $1,000 of an asset, and by the second year it'll be listed as $750. And that $250 difference is showing on your income statement as a depreciation expense for the year.